How's it going, everyone? And welcome back to another episode of T Talks. In this episode, we are joined by one of my mentors, the MMXM trader.
All right, what's up, guys? Welcome to T Talks. Thank you, T, first of all, for having me on. So most of you, as some of you know, I'm the MMXM trader. If you're in the ICT community on Twitter, you'll probably know who I am. However, on YouTube, a lot of you on T's channel won't know who I am. Some of you might, because T has a lot of videos on models and different things I've shared. And I was T's mentor earlier on. Once again, thank you, T, for having me on. I hope you guys enjoy the video. We're going to be covering market maker models, and we're going to cover them from a higher time frame understanding and perspective to a lower time frame understanding and perspective, because what a market maker model is it's a hedging program that the central banks use. And we're going to be looking at things like COT for that on the higher time frame to build in a higher time frame market maker model and the logic behind it, all the way down to trading it as a pattern, right? And that's what it is. It's a pattern. And because it's a pattern, we have to build a framework and narrative to be in alignment with the higher time frame institutional order flow and align ourselves with it, because trading a pattern on its own is meaningless. All right, so let's get into the higher time frame with the market maker models and looking at it as a hedging program on the higher time frame of the central banks. So you can see here I have a depiction of a market maker model, and I'm going to break down the logic of what a market maker model is and what's going on when you see that buy side and sell side of a curve. So this is a bullish example, so a market maker buy model, and you just inverse this for bearish. But what happens as price is declining on the sell side of the curve is the central banks are building in a net long position as price is declining. So yes, as price is declining and price is up here, they are buying into sell side liquidity and building in blocks of price that create sell side liquidity. Now, why would they be buying on the drop like this all the way up here as price is declining? Because they need to offer liquidity. The central banks offer liquidity to the large institutions and us as retail. And to offer liquidity, they need to hedge. So they buy in the decline as price goes down, and then they absorb all the sell side liquidity. And this is where they're net long. This is where the central banks actually make a profit. It's from the extreme net long position at the very low of a market maker buy model, the smart money reversal, or the very high. What they're doing here by buying here, they're hedging their positions here and they're selling them to the large funds. And this is how liquidity is provided. So if this was not going on in the market, there'd be no liquidity and the market wouldn't move. So that's why they're break even essentially on all these positions, offering liquidity. But this is where they make their money, right? So what does this look like on a COT, commitment of traders chart? So if you have a look here, this is the Japanese yen futures. And when we're looking at COT, we want to be looking at it on the futures chart. So individual future currencies, not euro against dollar or USD against JPY. You look at it on the individual currency like the yen futures, and you'd never look at it on the dollar. So you can see here, as price is declining here, we want to take the last 12 months of the COT data, and we want to split that 12-month range in half. And we want to see at a key time, which is at a new quarter for the higher time frame charts, if the commercials in terms of the central banks are net long or short. And at this point here, you can see obviously in the last 12 months, are they above a 50 line or below? They're actually at the highest high they've been in. So at this point here, the commercials are net long on their positions. That's this here. They're net long here, and we can see that reflected on the COT data. And now here is what it looks like on the chart. So this point right here is right here. So going back to that diagram, as the market is trading lower, they're buying as it's dropping, right? And that's, you can see where they're buying through the up close candles on the sell side of the curve, right? This is the positions where they're buying into the sell side, and then their extreme net long here. This is where they make money from their positions. So their goal of doing this is first to build in sell side liquidity buy side liquidity above the highs so they can pair orders, and to offer liquidity on the opposing end of the curve to large institutions. And this is why we use mitigation blocks, right? So we're mitigating the orders here on the buy side of the curve. And this is where we as market participants can position ourselves in long positions. We know where they're going to mitigate and where they're going to offer us a buying opportunity. It's in the old areas of institutional buying, which you can see with the up close candles. So this is what it looks like. When we have that smart money reversal and price starts to trade higher through the bullish bearish order blocks, you can see market comes back down into it. This is where they're mitigating those orders to go long from. You can see another example here. And here's the lower time frame. So this is a daily chart. And this is the lowest low where they went extreme net long. So at although a higher time frame discount level, and at a key time, which is a new quarter on the higher time frame chart. Now that covers the hedging program on the higher time frame, and we want to focus when we're trading the market maker models as a range. An MMXM, a market maker buy or sell model, is just a range high to low or range low to high, aka buy stops to sell stops or sell stops to buy stops. We trade lower time frame ranges as MMXMs by pairing it with a higher time frame key level. A lower time frame range will be identified as the most obvious price swing where the high and low or low and high connect to each other. So this is what our focus is when we're looking at a market maker model. You're going to have the original consolidation, which is a range high. You're going to have a distribution phase 1, distribution phase 2. Then you're going to have a smart money reversal, a low risk buy, which only forms after a short-term breaker in here, an accumulation 1, which will happen at old distribution as we covered, and an accumulation 2. The second stage of accumulation or distribution in a market maker model paired with SMT is the silver bullet. It's the highest probability trade you'll have in the market. So this is how we'd anticipate in accumulation phases here. And on the low risk buy, you'd be looking for a breaker here as well. So another point of mitigation. So here's an example. Remember, high time frame key level, lower time frame range, and that lower time frame range is going to be your market maker buy or sell model. So we have a premium and discount here. This is a weekly chart. We have a discount key level. It's only a key level because it's in discount. The market is bullish, institutional order flow. We trade back down into the discount key level. And on a lower time frame, you want a range, and that range is your market maker buy model. So as you can see, this low clearly connects to this high. This is your range low to range high. This is a market maker buy model. This is the sell side of the curve, and this is the buy side of the curve. Here is your original consolidation, dropping time frames. And now the lowest low, you want to mark that. Everything to the left is the sell side of the curve. Everything to the right is the buy side of the curve. So we want to match the old areas of accumulation or distribution and pair them here. So as you can see, an old area of institutional buying here with the bullish order block becomes a mitigation block. Now, when you're on the buy side of the curve, you want to pair the mitigation block with a PD array that forms within the range of that mitigation block. So you can see a fair value gap forms within the mitigation block. That is where the market will offer mitigation to go long from. We trade through this level as well. Here, we trade back down into it. Is there a PD array that formed within it? We have a bullish order block here. And this is how we trade and participate in the market maker buy model. Another example here, this is just the recent price action on DXY. And we actually went long here in the private group. So premium to discount, once again, key level, daily fair value gap here. And then we have a clear range on the same time frame here. So here, the range low, the range high here. This is our market maker buy model. Smart money reversal at the lowest low, low risk buy after the breaker, remember, accumulation 1, Second stage accumulation, which is the silver bullet, which is usually the biggest, most explosive move and the highest probability move when paired with SMT. So we're going to extend the mitigation blocks from the sell side of the curve to the buy side of the curve, and we're going to pair it with a PD array. So here's the mitigation block here in terms of a breaker. We pair it with the bullish order block here. It gives us an area of buying. You have these two down close candles where there's old institutional buying. We pair it here with the fair value gap here to go long from. Then the second stage of accumulation, the silver bullet, we have another position of mitigation. We extend it and we have another area where we can go long from. We have that SMT at a fair value gap here, making this the highest probability trade here. Now let's talk about external and internal range liquidity, internal and external. T has a lot of videos on this on his channel. So if you haven't got down internal and external range liquidity, I'm sure T will link that somewhere for you guys. So we're going to pair that with time frame alignment with the internal and external range liquidity. Time frame alignment for market maker models, and what do they look like? One of the keys to finding clean market maker models is understanding the time frames they form on their relation to the time frame of the PD array. Timeframes are directly linked to each other, and if you stick to the rules I give you today, you'll have a lot more success identifying them. So this is the time frame alignment we're going to use for internal to external or external to internal. This is not for the ranges. This is just for internal to external and external to internal. We're going to be pairing a monthly PD array with a daily market maker buy or sell model, weekly with a 4-hour, daily with a 1-hour, 4-hour with a 15, H1 with a 5, and M15 with a M1. So in a market maker buy model, there's almost always two stages of accumulation on the sell side of the curve, so as we're dropping down. And in a market maker sell model, there's almost always at least two stages of accumulation on the buy side of the curve. The curve is defined by the lowest low in a market maker buy model and the highest high in a market maker sell model. And this is what it looks like. So original consolidation, accumulation 1 and 2, the lowest low, sell side, buy side of the curve, bearish example, buy side and sell side of the curve with the two accumulation. So here's an example of the Australian dollar on the monthly chart. And remember, we're covering internal to external, external to internal plays on market maker models. We take external range liquidity defined by the swing high. The market takes the external, then it draws to internal defined by a fair value gap. From here to here to here on a daily time frame is a market maker sell model. So if we drop to the daily time frame, this is what it looks like. So this is your external range liquidity, this is your internal. We have that original consolidation, an accumulation phase 1, accumulation phase 2, then we have the smart money reversal, the highest high, displacement lower, then we have the sell side of the curve. Another example here. Internal to external, this is a weekly internal range liquidity defined by the fair value gap. We're trading to the external range liquidity sell stops. This here on a 4-hour is a market maker sell model. So as you can see here, again, the time frame alignment for the market maker sell model here. Now daily to H1. You've got the daily market, the daily low to a H1 high here. We have a original consolidation on the hourly, accumulation 1 and 2. We run the daily low external and we trade higher on the buy side of the curve to attack the market maker buy model on the hourly. Here is a 4-hour chart on Euro AUD. And if you look at this here, here's our internal, external. We're defining it by this one because it's in discount. So from this high to this low, this move here is a market maker sell model on the 15-minute. And you can see that clearly here. 15-minute original consolidation, accumulation phase 1 and 2 before the smart money reversal heading into the sell side of the curve. So you can see when you blend the time frame alignment, this is when you can find very clean and clear market maker models. Here is a hourly internal to external range play, and this here is a 5-minute market maker buy model. Original consolidation, accumulation 1 and 2, and you can see we deliver to the high here, which is the internal range, the external range liquidity. 15-minute, from this high to this low with the internal here. Just this here, this move up to here and down to here on a 15-minute is a complete 1-minute market maker sell model. Original consolidation, accumulation 1, 2, smart money reversal, and then price sells off into the sell side of the curve. Now we're going to blend the time frame alignment with where we can find entries, which is, as we've covered, the mitigation blocks. So utilizing mitigation blocks for high probability entry trades in a market maker model. All right, so here's the Australian dollar example again. We went from the monthly external to internal range liquidity. Here are your bullish order blocks. So your mitigation blocks, we want to extend this out to the sell side of the curve, and then we want to pair it with a PD array that forms within the range of the bullish order blocks turned mitigation. You can see we extend the first one out. Does it have a PD array that forms within it? Yes, we have the fair value gap here that forms within it. Mitigation occurs here, sells off. We come back up into the bullish order blocks here. We have a bearish order block formed within the range. You can see mitigation occurs there, we sell off. If we go to the next mitigation block here, extend it out, you can see a fair value gap forms within the range here. So when we're pairing the mitigation blocks with the sell side or buy side of the curve, we're going to see a new PD array form within the range. GBP CAD example here on the daily to the hourly here. So you can see here, we have the original consolidation, a few accumulation phases here, 3 in this case, then the smart money reversal. So you can see the mitigation, the bullish order blocks here, we're going to extend them out. The first one here, we extend it out. We trade through it. A PD array forms within the range of the order block. Mitigation occurs here to long. We extend the next one out. Fair value gap forms within it. Mitigation occurs here. Once again, the last set of up close candles that we can use for mitigation, you can see order block here, the 2 down close candles formed within it. You have an opportunity to go long there.
Thank you, MMXM, for coming on and sharing with us. If you guys did enjoy it, make sure to check out his links in the description below. And if you want to see another video from MMXM, go ahead and like and subscribe, and then leave a comment in the comment section below on which topic you would like discussed. With that, I hope you have a great rest of your day, and I'll see you guys next time.